Hello, I'm Jesse Colombo, and in this presentation I'm going to explain the key conditions necessary for silver to finally surge, just like gold has. First, a little bit about me. I'm an independent precious metals analyst, investor, and newsletter writer. I'm also a popular financial media personality who became known for warning about the 2008 global financial crisis as a university student. And I'm a skeptic of mainstream financial markets and an advocate for free markets and sound money. After going nowhere for the past 5 months, many silver investors are growing frustrated and are questioning whether silver will shine again. I believe it will in a big way once several key conditions are met. The first condition is straightforward, yet largely overlooked by investors and has proven surprisingly challenging to achieve. And that is the spot price of silver closing decisively above its $32.50 resistance level, backed by strong trading volume. The $32.50 resistance level was established at the May high, after which silver pulled back and remained stagnant over the summer. Silver recently attempted to break above that level on September 26th and October 4th, but both efforts fell short, resulting in pullbacks. I believe the time is approaching, however, when silver will finally break through and close above that level, sparking a significant rally. Once that happens, I expect silver to surge rapidly to approximately $50 an ounce. The next condition is that silver, priced in euros, must close decisively above the €30 resistance level that formed at the May peak. This event would help confirm a close above $32.50, greatly reducing the chances of it being a false breakout. I find it valuable to analyze silver priced in euros, as this approach removes the impact of US dollar fluctuations, offering a clearer view of silver's intrinsic strength or weakness. Notably, silver priced in euros often respects round numbers like 26 euros, 27 euros, and 28 euros, frequently establishing key support and resistance levels at these points. The final condition is more esoteric, but I believe it will significantly reduce the likelihood of an upcoming silver breakout being a false one. An index I developed called the Synthetic Silver Price Index must close above its key resistance zone between 2,560 and 2,640. This index represents the average of gold and copper prices, with copper's price adjusted by a factor of 540 to prevent gold's higher price from disproportionately influencing the index. The price of copper is an often overlooked factor in silver's performance and rivals the influence of gold. The index closely mirrors silver's price movements, yet surprisingly, silver's price itself isn't even an input. Interestingly, performing technical analysis on the chart of the synthetic silver price index is a useful tool for confirming and anticipating silver's price movements. The price of gold itself is creating a significant tailwind for silver, and its confirmed uptrend means that even further gains are likely. There is a high probability that gold will hit $3,000 an ounce in the near future, which isn't as preposterous as it sounds, as that is only 13% higher than the current price. Silver mining stocks are also worth watching for confirming silver's price movements, as they often mirror investor sentiment toward the metal. The Global X Silver Miners ETF, which trades under the symbol SIL and is the most heavily traded silver mining stock ETF, has been stuck in a flat range since April. A strong high volume close above the $36 to $38 resistance zone would signal that both silver mining stocks and silver itself are poised for a significant breakout. Similarly, the Amplify Junior Silver Miners ETF, which trades under the symbol SILJ and is a key proxy for junior silver mining shares, has been range bound for the past 5 months. A decisive high volume close above the $13 to $14 resistance zone would indicate the start of a rally for both silver mining shares and silver itself. The gold to silver ratio is a valuable indicator for gauging silver's price direction. A double top chart pattern appears to have formed over the past 2 months, indicating a likely decline in the ratio. This suggests that silver may soon start outperforming gold. A close below the 82 to 84 support zone is key to confirming the start of a silver rally and its outperformance of gold. As I said earlier in this presentation, there is a high probability that silver will quickly run to $50 an ounce in the next leg of the bull market. I'm focusing on $50 an ounce as a relatively short-term target because it's a significant psychological level and the peaks reached during both the 1980 and 2011 rallies. One of the reasons why I'm so bullish on silver is because its monthly chart reveals a recent breakout from a massive 2-decade-long triangle pattern. This breakout signals that silver is on the verge of a powerful bull market. As if there's not enough to be excited about already, silver's logarithmic chart dating back to the 1960s reveals a cup and handle pattern that suggests silver could reach several $100s an ounce during this bull market. This scenario must be confirmed by a close above the $50 resistance level. Although silver has already surged nearly 50% this year, there are plenty of reasons to believe that it is just getting started. One reason is that the long-term gold to silver ratio chart shows that silver is currently undervalued compared to gold. Right now, the ratio is 84.2. If the ratio were to revert to its historical average of 52.8 since 1915, even without any increase in the price of gold, silver would be valued at a solid $50.36 per ounce. Adjusting silver's price for inflation further highlights how undervalued it is by historical standards. During the Hunt brothers induced spike in 1980, silver reached an inflation-adjusted price of $143.54. In the 2011 bull market, driven by quantitative easing, it hit $68.04. Currently trading at just $31.60, silver has significant room to rise if it's to catch up with these previous inflation-adjusted peaks. Another way to assess whether silver is undervalued or overvalued is by comparing it to various money supply measures. This chart shows the ratio of silver's price to the US M2 money supply, providing insight into whether silver is keeping pace with or outpacing or lagging behind money supply growth. If silver's price significantly outpaces money supply growth, the likelihood of a strong correction increases. Conversely, if silver lags behind money supply growth, it suggests a period of potential strength ahead. Since the mid-2010s, silver has slightly lagged behind M2 money supply growth, which, combined with the other factors discussed in this presentation, could position it for a strong rally. In conclusion, silver is on the launch pad building up energy for a significant breakout. While investor frustration is understandable after months of stagnation, it's important to keep the bigger picture in mind and consider the many bullish factors supporting silver. The combination of breaking key resistance levels, both in US dollars and euros, along with confirmation from the synthetic silver price index, will signal that the rally has officially begun. With historical trends and undervaluation further supporting this outlook, silver could be on the verge of a major run toward $50 and beyond. If you enjoyed this content, please hit the subscribe button and like this video. Also, I recommend subscribing to my newsletter, The Bubble Report, where I discuss precious metals and global economic risks in even greater detail. To subscribe to this newsletter, click the link in the video description below. Once again, my name is Jesse Colombo, and I hope you enjoyed this presentation.